Hi, I'm Jimmy. In this video, we're looking at American Express, ticker symbol AXP. This video is part of our Dow 30 series, where we're analyzing all 30 companies in the Dow Jones Industrial Average so we can see which companies look like they're a good company and which ones look like they're a good buy right now, even in this overpriced stock market. I'll leave a link in the description below to all the companies we've completed so far. Okay, so first we're going to look at American Express's business, and then we're going to see if we can come up with a fair value for American Express's stock. And then hopefully we can use this information to see if these companies belong in our investment portfolio and ideally get us closer to our goal of achieving financial freedom. Okay, so let's jump right in. So we can break American Express's business into three primary segments. Their largest segment, this is according to their 2020 revenue, well, their largest segment was their Global Consumer Services Group. This part of their business accounted for about 58% of revenue in 2020. Then their global commercial services business put up about 29% of revenue. And then finally, their smallest part of their business is their merchant and network services business. That put up about 13% of revenue in 2020. Now, clearly, we can see that American Express is a global business since they label every group as global. Although the United States did account for about 78% of total revenue in 2020. So yes, it is global, but the United States is very dominant in where they generate their revenue. Okay, now basically, American Express does a couple different things to make money. First, as many of us know, American Express issues credit cards. And the revenue that they generate from those credit cards are accounted for in the two largest segments. And generally, they target people and companies that spend a lot of money and ideally for them, have higher credit scores. Now, of course, the other side of this revenue equation for American Express are the fees that they generate from the merchants that accept their credit cards. That, of course, goes into the smallest segment that they have. Okay, now American Express can make money in a few different ways. Many times, they charge fees on the credit cards that they issue. So if we were to have a American Express credit card, well, then perhaps they charge us an annual fee for having that credit card. So, of course, American Express makes money there. Then if we carry a balance on that credit card, they earn the interest that we pay them on a monthly basis. So again, they make revenue there. And then when we use our card at a store, well, the store or the merchant has to pay a fee as well. So American Express is really attacking the transaction from both sides. Now, American Express also offers card member loans, so they're able to generate some revenue from the loan department as well. Now, because they're giving out loans and they're essentially a bank, well, now they have to meet some reserve requirements. So they're required to keep a certain amount of liquid capital on hand just in case there is defaults and to meet some of the government requirements that are out there. And as of their most recent quarter, well, American Express more than covers the reserve requirements that they have to keep. Okay, now we should also point out that American Express spends a lot of time and money and effort into their membership benefits. So things like their points or rewards programs or discounts that they offer. Now, over the past year, or even the past quarter, which just recently came out, it was last week that they came out, well, as we can imagine, travel and entertainment are a very big point of focus for American Express's business in general. Think all the rewards points you get, flights, things like that you might get from using an American Express credit card. Well, travel and entertainment have been crushed over the past year thanks to COVID. So we can see that in their revenue numbers over the past year. 2020 was a very rough year for American Express because a very large part of their business was hit. In fact, the last time revenue saw this kind of pullback like it did over the past year, well, that was the financial crisis back coming out of 2007 going through 2009. Now, the question for American Express going forward is how long is it going to take them to recover to pre-COVID levels? Looking back at 2007, look at the numbers back then. Well, back then, coming out of the crisis, it took them many years. It took them all the way up to about 2014 before they got back to where they were before the market crashed. Now, it's not expected that this recovery will be quite as long. So now if we add analyst estimates for the next 2 years for revenue, well, we can see that analysts are expecting over the next 2 years for American Express to get back to about where they were before COVID happened. And this seems fairly logical. One of the real problems, like we mentioned before, was the travel and entertainment part of their business. And over the next couple of years, I could very much see a lot of that coming back. So in theory, that should help American Express in the long run. Okay, now we have some background on American Express's business. let's see if we could take a peek at what we think American Express's stock could be worth today. So, the last time I analyzed American Express's stock, well, I used the traditional price to earnings multiple to try to come up with a fair value. And frankly, this usually works perfectly fine for an American Express or even a Discover or a Visa, could work fairly well. The only issue right now is when we look at the history of American Express's price to earnings multiple going back the past few years, well, we can see that things look fairly crazy right now. And this is mostly because the price of American Express's stock kept moving higher through 2020. From about March of 2020 onwards, the stock went up along with the stock market and earnings per share went down. So we ended up with a very lopsided price to earnings multiple. Now I say it's a bit crazy right now because look at how fast this PE multiple dropped just recently when earnings came out. And this drop was mostly because earnings over the past quarter were fairly good relative to the past year. So we had a big jump in earnings per share and the price stayed about flat. So when you have the price about flat, earnings per share jump up, the PE multiple will drop down. Okay, now I've also calculated the long-term average over this entire time period for the PE multiple. And we can see that the average comes out to be about 16 times profit. So in theory, we want to pay less than this long-term historical average for American Express's stock. And given that the PE ratio is currently in about the 24x range, well, I'm not sure it makes a lot of sense to jump into American Express at this point. But is the price to earnings multiple the only way to do it? No, another valuation method we can look at is something like the price to book multiple. This should smooth the numbers out a bit. And when we look at the actual chart going over the very same time period, well, we can see that the price to book multiple over the past 10 years has averaged to be about 4x. So that's right now the price is the average 4x is the price is on average 4 times greater than the book value of the company. Well, today the price to book value is almost 5x. So again, it's not as crazy as the price to earnings multiple was, but it still looks overvalued. And if we're curious, if we were to use the long-term average for the price to book multiple, which I think is one of the smarter methods to use with a financial stock, well, given that the current book value, not price to book, current book value is slightly over $30 per share, and the 10-year average came in slightly below 4x. Well, that would mean that the fair value of their stock using this long-term average is about $117 per share. So when we switch over to the stock chart here, well, we can see that the stock is currently trading at about $150 per share, which puts it above our ideal entry point of about $117 per share. Not even ideal entry point. That I would say that's closer to our calculation of fair value. We want to buy it below our calculation of fair value. Now, I personally really like American Express's business. I just don't want to overpay for the stock. I'd like to see it drop below our $117 before we would consider getting involved. Now, if you're curious about a good process for researching a company like American Express or really any company, well, I actually did a video where I go through 8 steps for analyzing a stock. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.